Hey, welcome back everybody to another video where we're going to analyze the Brazilian payment processing company StoneCo Limited, ticker symbol STNE. Now this company currently has a market cap of about $2.45 billion, and it presents a really interesting opportunity along with a lot of other Brazilian companies for reasons that we will see in just a few minutes. But before we take a look at the numbers and the bigger picture, let's quickly learn about StoneCo and what it does as a company. So in its simplest form, StoneCo is a payment processing company that focuses on financial and software solutions for micro, small, and medium businesses in the Brazilian space, and essentially functions a lot like American companies you might be familiar with, like Block or Square as it used to be known. And StoneCo is a pretty young company, originally founded in 2012. The company now makes up 11% of all market share in payments among total payment volume in micro, small, and medium businesses in the Brazilian space. Now, this is significant because a lot of the Brazilian market is still very fragmented. A lot of transactions still do occur in cash, so there is a huge addressable market, as we'll see here in a second. So as this graphic shows, there's a huge unpenetrated total addressable market for StoneCo and basically any other payment provider in the Brazilian space. The darker green boxes represent StoneCo's market share in each category. So in this case, this is the payment category for medium, small, and micro businesses. And StoneCo has a 15% market share in that. If we look at the large cap companies, StoneCo has a 4% share in those. StoneCo has recently moved into banking, software, and credit spaces as well, so they have very small market shares currently, with the exception of software, which is quite large. But those market shares we may expect to see grow quite rapidly, similar to other Latin American fintech companies. I'm thinking like New Holdings, which is ticker symbol NU. Breaking things down just a bit, we can see that StoneCo's revenue comes mostly from the financial services, 88% of that, and that's done with micro and small and medium businesses working with their payments for the most part, as well as some banking and credit options. The company is also trying to grow their software, which currently makes up 12% of their revenue, and they are doing this through point of sale and enterprise resource planning solutions in an effort to create a full stack where one company, that is StoneCo, can assist other small, medium, and large businesses with an entire stack of enterprise planning as well as payment processing systems. And taking a look at the company's competitive advantages, I think this tech-enabled distribution is kind of dumb. It's all a bunch of hypotheticals, right? Like 99% of Brazil's GDP covered. Who cares? You don't actually cover that. That's just what's potentially able to be covered in a perfect world. But what is important is the superior client service of this company. They have a very fast turnaround time, that 1 to 3 days. It takes 5 seconds to pick up a phone call. If you call into this company, on average, I would assume, if you wanted to talk to their customer service, and they are consistently ranked #1 in client satisfaction in Brazil, which is excellent. You want your customers to want to stick with the company and continue to use your product. And then I think the second big competitive advantage would be this vertical value proposition. The company is leaning into this quite heavily, but they're looking to integrate, payments, banking, credit, point of sales, enterprise resource planning, all into one company that will hopefully eventually allow you to do so many different things with one product that you'll have no choice but to just save money and time and effort and just use that one product. So I think there is a huge potential for this value proposition at scale, which is what the company points out. And time will tell if StoneCo is able to achieve that. Revenue growth in their financial services section has been amazing, 60% CAGR over the last 2 years. And margin expansion has led to an EBT growth of 476% per year over the last 2 years. They've seen massive growth in payment active client base from about 2.3 million clients to just under 4 million clients in the last 2 years alone, as well as huge growth in the banking client base from about 561,000 to 2.8 million people, again, in just the last 2 years. Total payment volume is up 22% per year. The company's take rate, or the amount that they are earning per transaction, is up from 2.21% to 2.58%. Again, really good. Client deposits are up 52% over the last 2 years, as well as credit portfolio that is 8.1 times higher than it was 2 years ago. Now, what puts a slight dent into the company's growth story is the software revenue, only up about 4% per year over the last 2 years. though EBITDA as well as margins continue to grow quite nicely. So hopefully this is just a speed bump and we can see StoneCo continue to grow its software revenues over time as it did from 2021 to 2022. Taking a look at some of StoneCo management's guidance, we can see that their total payment volume for micro, small, and medium businesses is expected to grow at about 13% per year through 2027, which is pretty solid numbers. And what's even more impressive is that they're expecting their client deposits to reach 26% compound annual growth rate through 2027, which would mean their 6.1 billion real deposit base currently would grow into something more like 14 billion in 2027, basically a 2x. Management also expects growth of 21 basis points or 0.21% in the company's take rate for these transactions, which is really impressive growth considering we started about 2.21% in 2022 and management expects it to be at 2.7% by the end of 2027. The company's credit portfolio is also expecting to have massive gains of about 90% compound annual growth through 2027. I'm not exactly sure how the company plans on reaching that huge growth. It's currently sitting at about 309 million reals, and they're expecting that to be about 5.5 billion reals by the end of 2027. They can do this through credit cards, working capital, and revolving credit loans to the companies they work with. So it might be interesting to figure out where this huge growth is expected to come from. I also think there's a huge chance for growth just by cross-selling products within the StoneCo ecosystem, and that seems to be what the company is really focusing on. On the far left here, we have the RPAC, or basically the average revenue per user or per active client by number of products used. So if the number of products is up to 3 products, the company has indexed that revenue to 100, meaning anything, above 100, let's say 150, would mean they generate 50% more revenue than the baseline of up to 3 products. So with their customers using more than 3 products, they earn an indexed value of 214, which would be 2.14 times more average revenue per active client, net of funding costs, which represents a huge opportunity because in the next 2 sections, we can see that there are plenty of customers that are using less than 3 products. So if StoneCo can continue to build that ecosystem and encourage people to stay within their ecosystem, they should have huge revenue growth from that. So case in point, this middle one is talking the share of clients by number of products used. 66% or 2/3 of clients use less than 3 products or up to 3 products, and only 1/3 uses more than 3 products. So plenty of growth there if StoneCo can push it. And it does seem to be that the company is successfully pushing this, as we can see the percent of clients with more than 3 products used by sales cohort, basically, when did they join with StoneCo's system. So Q3 of 2023, 28% of that cohort is using 3 or more products. And now 1 year later, the newest cohort is 43% of users are using 3 or more products from StoneCo. So I think StoneCo's sales team is delivering, the product is clearly delivering, and so I think the company does have reasonable expectations of getting more and more clients from the 66% into that 34% bucket where they're using 3 or more products. And finally, we need to end on a little bit of bad news here. Okay, so StoneCo, along with basically every Brazilian bank, is starting to see a pretty large uptick in their non-performing loans. What is a non-performing loan? Well, it's basically a loan that isn't being paid back. So there is the potential that the loan defaults and you never receive your payments. So we can see it's gone from 0.3% in 2023 up to 1.9% in 2024 for all non-performing loans 15 to 90 days. Those would be the kind of less worrisome non-performing loans, but growth in that section is also not good to see. Now, what is more worrisome is that there was actually 0 non-performing loans in second quarter of 2023, and that number has jumped all the way up to 3.7% of all loans non-performing over 90 days. So that means in the last 90 plus days, these loans have not had any payment received, and StoneCo is not earning any money on the loans. Now, what is interesting, you might find this really interesting, is that the company calls this a low non-performing loan ratio for the portfolio, which by American and maybe European banking standards, this would be a little bit worrisome, right? Like 3.7% of your loans are over 90 days delinquent. That's kind of a bit high. But actually in the Brazilian market, that is considered pretty low. So I still advise caution because, with Brazil going through the economic challenges that it is, we could see a very sharp rise out of nowhere in the non-performing loans, and of course that would mean a lot of losses for StoneCo and basically all of the Brazilian banks. So now that we've taken a moment to learn about StoneCo, what the company does, and some of the most important metrics that management has laid out, let's take a look at some recent news, starting with a $2 billion share repurchase program that the company has recently announced about a month ago. And I should clarify, when I say $2 billion, I meant 2 billion Brazilian reals. So, obviously they're a Brazilian company, so they're using reals. But in any case, that's still 2 billion reals. That's a large buyback program. And StoneCo is using its financial resources to buy back stock at a very, very cheap price, might I add. This comes on the heels of a 1 billion real purchase program where StoneCo successfully purchased 13.2 million shares at an average cost of $13.52 each. Now, as we'll see, the company's price has fallen quite a bit from that $13.52 range, but I still think even at $13.52, the company probably got decent value buying its stock back. Now, what is really driving this huge market downtrend for StoneCo, for other companies like NU, ticker symbol NU, PagSeguro, ticker symbol PAGS, any of your Brazilian banks or other industrial companies based in Brazil, is basically that the Brazilian real has hit a record low as the markets are eyeing government spending. We will take a look at the USD versus Brazilian real chart in a second here, but basically there are 2 points that stand out about Brazil's economy, and that is number one, very, very high deficit spending. The country has a huge deficit planned in its most recent fiscal budget. And number two, high inflation leading to higher interest rates rising. So the country is running high deficits at a time when inflation is rising, causing the central bank to start raising their rates. So this is kind of an ugly situation here where the monetary policy of the country does not really match the fiscal policy. And so because of that uncertainty, we're seeing the market take a lot of risk off the table in these Brazilian stocks, and especially in the Brazilian currency itself, where the market fears hyperinflation, essentially. And so what we're looking at here is the Brazilian real versus the United States dollar starting in 2021 and then ending, obviously, in the most recent trading day. So through 2021, 2022, and into 2023, we can see kind of stagnant, but a generally increasing value of the Brazilian real against the US dollar. Now, part of that reason is because Brazil is quite a commodity-focused economy, and so in times of inflation, general global inflation, I should specify, commodity-producing countries tend to do pretty well. Unfortunately, a lot of the world's inflation is starting to fall, but Brazil's is starting to rise. The country wants to continue spending, or the country's government wants to continue spending at huge record paces, and the central bank of Brazil wants to raise rates. But starting in 2024, we've seen a huge drop-off in the value of the real, going down against the US dollar about 22% to yesterday's close. And that is significant because it is essentially the market's way of saying that the actions that are occurring in Brazil are probably unique to Brazil, and they're probably going to create problems for Brazil. So if there are economic troubles ahead for Brazil as a country, obviously all of the companies that are heavily involved in Brazil, which includes StoneCo, are going to struggle as well. So that is why we do see a major drop in many of the Brazilian stocks on the market today, and StoneCo is no different. As always, I want to take a little interlude to say thank you so much for watching the video. If you could please hit that like button, subscribe to the channel, and leave a comment down below. Let me know your thoughts about StoneCo or any other stock in the stock market. I would love to have conversations with you guys. With that, let's get into the balance sheet, the income statement, and let's check out some valuation metrics. So StoneCo really is a story of huge growth, but huge growth in many different ways, both positive and negative. So their total revenues are growing about 40% per year over the last 5 years. Gross profits up 36%, operating income 33%. I mean, that's all really beautiful, but that is also being quite closely tracked and sometimes even outpaced by the cost of their goods. So 55% growth in cost of goods sold, 38% growth in their SG&A expenses. And if we scroll a little lower, we can see a 17.5% increase in the company's net interest expenses. So all in all, there's excellent growth here for StoneCo, but the company is also growing its costs at a similar, if not sometimes outpacing rate, which is not something you necessarily want to see. Taking a look at the company's earnings, we can also see that that's been a little bit fluctuating in both the earnings from continuing ops, net income, and diluted earnings. 2021 and 2022 saw negative numbers, which I think also underlines the fact that a company like this, a payment company, does rely on a local economy, and if that local economy is struggling, we should expect this company to struggle as well. Diluted shares outstanding have been growing at about 2.2% per year, although I do want to say that the high watermark was in 2023 at about 319 million shares outstanding, and they currently sit at about 308 million. What is more promising, though, is that the company's EBITDA is growing about 32% per year, and its EBIT, or earnings before interest and taxes, has grown about 33% per year. Although that growth has not been steady, as we can see 2019 through 2021 saw shrinking EBITDA and EBIT margins before a huge explosion into 2023, and again, a slight pullback into 2024. StoneCo's capital expenditures are quite variable, and that's okay. The company is still in its growth phase, so it's not too much of a worry. The net debt issued is also quite variable, so some years they're paying back a ton of debt, some years they're issuing a lot of debt. Recently in 2024 was the year they issued quite a bit of debt, though I don't think it's unmanageable for the company, as we'll see in a second here on the balance sheet page. But I do want to point out that their levered free cash flow went from extremely negative in 2019 to positive for several years, and then again pretty negative in 2024. So the free cash flow, I think, is something that we should watch pretty closely for StoneCo. Hopefully they can turn that around relatively soon. Cash and short-term investments on hand have gone down by about 5% per year, but it currently sits with cash on hand of about $805 million, which isn't too bad considering the total market cap for StoneCo is about $2.5 billion. So it's quite a bit of cash sitting for the company currently. Receivables up about 9% per year, total assets 18% up per year, but their liabilities also about 18% up per year. So again, kind of this one-for-one growth in assets, growth in income, but also growth in expenses and liabilities, especially long-term debt, which is up about 34% year over year. And StoneCo really does seem to be leveraging up here in 2024. What is nice to see, though, is that stockholder equity is continuing to grow, although 2019 is a pretty favorable point to start. It's been basically flat since 2020. Book value share, again, same story, up 15%, but mostly flat, kind of just fluctuating since 2020, along with tangible book value per share. The company's net debt has increased significantly in 2024, although, like I said, it's generally pretty manageable. Gross margins are excellent, currently sitting at about 73%, which is really good for just about any company out there. Operating margins coming down a bit, but still at 45%. And of course, the company's free cash flow margins are negative because of their recent negative free cash flow, although we have seen it as high as 75%, which is certainly unrealistic, and maybe something closer to like a 15 to 20 would be realistic for this company over the long term. Return on assets currently sits at about 4%. Return on equity is about 13.4%. So that's a pretty solid number, especially for a financial company. I don't see anything to worry about with StoneCo's current ratio, which sits just under 1.5. The company's quick ratio, again, just under 1.5. Its cash ratio is about 0.16, which, that would be great if it was higher, but that's certainly nothing to worry about considering the other ratios look really good. Again, we do see a spike in long-term debt, so there's a long-term debt to equity increase. But what I do want to point out is that if we take the long-term debt and put it into terms of EBITDA or EBIT, these numbers are quite a bit lower than in 2019, 2020, or 2021, which implies that the company can still handle this debt load and could probably still handle quite a bit more debt if it wanted to. And then finally, as a last quick look at whether it can cover its debts, the EBITDA interest coverage is at about 6.6 times, so easily covers there. Their EBIT interest coverage is 6.1 times, so again, easily covers their interest expenses. Obviously, with negative free cash flow, we're going to have a negative number currently, but as of 2023, they could even cover with about 2.7 times their free cash flow. So I don't see any reason why StoneCo would not be able to handle its current level of debt. And so now we're at the part of the video where we look over valuations for the company and we try to see if StoneCo is a good buy currently. And what I want to point out before we get into anything is that StoneCo had major hype following its IPO in 2018 or maybe 2019. And this company traded at sky high valuations. So that's going to skew a lot of our graphs here. What I would like to just point out is the general baseline numbers then, because obviously the averages are going to be just way too high over the last 5 years. So starting with price to sales, I mean, its average, like I said, 10.91. That's definitely way too high. But the company currently trades at 1.1 times its current price to sales, which is a pretty solid deal. Taking a look at the company's average PE over the last 5 years, that's at 8.31, and that's highly skewed by positive and negative swings in its earnings. But the current price to earnings for StoneCo is 6.95, which is incredibly low. And if we take a look at analysts' values and their estimates for future earnings, The company's stock, which is currently trading at about $8.20 per share, should be worth about $10.50 by the end of 2025 and about $12 by the end of 2026. So that represents basically a 50% close from about the $8 range that it closed at recently to that $12 fair value price in the next 2 years. Certainly something that I think people should take a closer look at. On a price to EBITDA basis, again, highly skewed, average, but trading at 2.27 times StoneCo's price to earnings before interest, taxes, depreciation, and amortization. Different types of companies, different countries where those companies are based, as well as the general market outlook for certain industries can really heavily fluctuate what a fair price to EBITDA is. But let me tell you, 2.27 times is ridiculously low for almost any company. I mean, that's basically pricing in a company that's in long-term decline. Again, we see that just on an absolute basis, StoneCo is at a very, very interesting valuation. Price to EBIT, much the same, 2.46 times. If you're familiar with Warren Buffett's rule about buying banks, he uses EBT instead of EBIT, but 10 times EBT is what he considers to be a very good value for buying a bank. So if we used EBT instead of EBIT, this number would be slightly higher, but you're pretty safely underneath that 10x range for a financial company, according to Warren Buffett himself. Price to free cash flow is kind of useless considering the fluctuations between positive and negative and its current negative total. Book value is quite interesting though, because it's trading at 0.87 times the company's book, meaning the stuff that it has on its balance sheet is worth more than what the company's stock is currently trading at on an overall market cap basis. Price to tangible book also shows a big discount. The tangible book shows up 2.09 times. So if we're using only physical assets and the different assets that go into tangible book, the company looks a little bit more expensive, but still 2.09 is not bad, especially for a fintech company that has such large expected growth ahead of it. When we take a look at StoneCo's enterprise value, which takes into effect its market cap as well as the company's debt, and then we compare that to EBITDA, it's trading at 6.17 times, which again, ridiculously low. I would say just your general fair EV to EBITDA for any company on the market, throw it at a dartboard, it's probably going to be in that, let's call it 14 to 16 times range. So 6.17 is quite low. And taking a look at the company's drawdowns, again, due to all that fanfare when the company first IPO'd, we see that StoneCo is in a huge drawdown of approximately 91%. And I think it is important to mention that the vast majority of companies that undergo a 91% drawdown never come out of that drawdown. Very, very rarely does that happen. But I think that was mostly due to this kind of just irrational exuberance about the growth of Brazil and the BRICS economies at the time, as well as the fact that fintech was the next big thing. So the company just IPO'd at a ridiculously expensive price. We can see it's been basically fluctuating at this, let's call it 80 to 90% drawdown for the last couple of years. But I do think that, as we've just seen, StoneCo has a really solid value proposition currently. So if we take a look at the X factors, think again about how low the company's PE and enterprise value to EBITDA is. You'd expect this company to be priced basically for either no growth, stagnation, or even a small decline in its growth over time. Let's call it 2 to 4% shrinking every single year. But instead of seeing a company expected to shrink or stay basically the same, StoneCo is expected to grow at 19.55% per year for the next 5 years. Let that sink in. You're paying a price to earnings ratio for a company that would essentially assume that the company goes nowhere for eternity, except this company is going to grow at 20% per year for the next 5 years if analysts are correct. That's a huge mispricing, in my opinion. Now, is that mispricing with good reason? Maybe. That's for you to decide, do a little bit more research, but the mispricing here is very big. And due to that, we have a PEGI ratio of 0.36, which I think might be the lowest ratio we've seen since I started portraying this ratio. So again, if you're unfamiliar with what this is, it's the price to earnings or PE of the company, and then we divide that by its growth, expected growth, which would be 19.55%, plus its dividend yield, which in the case of StoneCo is 0. So it's essentially just its current PE of, let's call it 6, divided by its expected growth of 20, which gives us this 0.36 number. Anything below 1 is considered a pretty darn good value. Anything below 0.5 is, something's got to give. Either the company is not going to grow at 20% or it is priced incredibly wrong. So you need to do a little bit of research, figure out what you think is a fair value for the company. But this PEGI ratio is basically telling all of us that we need to look at StoneCo a little bit more in depth. And so with that, I just want to go over my 3 likes and dislikes for this company. Number one, I really like the strong growth metrics at a very reasonable price. I mean, it's hard to find a company growing at 20% per year, or expected to grow at that rate, trading at less than a 10 times price to earnings ratio. I mean, that's so hard to find in any market, but especially a market like today. Second, there's a very large and growing total addressable market. Brazil is an emerging market economy. There's plenty of growth for the country's economy as a whole over the next several decades, but even within that, there's plenty of growth still ahead for the non-banked population, the population that just solely relies on cash. I mean, it's a huge proportion of Brazil's economy currently is all just cash. And so the digitization of that and the ability to make that easy for small businesses to transition to using digital payment is huge. And so I think that in a growing economy, this is a growing industry as well. And third, high customer satisfaction scores are always excellent. I mean, if you're number one in your industry for customer satisfaction, I think you should expect to have decent growth for a solid period of time. You're going to get organic growth from new companies and new customers, but you're also going to get that growth from other companies that are just sick of their current provider and want something that is streamlined and want something that is going to take care of them. So I really like it when I see that a company is the number one in its industry for customer satisfaction. But moving on to what I don't like, it's the growth in non-performing loans is worrisome. Obviously, you don't want to see that for any bank. What I did mention when we were going over those numbers is that Brazil as an economy and as a banking industry within Brazil, they tend to have higher non-performing loan numbers, and I do believe StoneCo's is underneath the average. So that is solid. It means that their lending is a bit more conservative or intelligent versus their average peer. But still, we don't like to see a growth in non-performing loans for any company at any time. So that is something that definitely needs to be monitored. Second, the weakness in the Brazilian real is, although not necessarily a headwind for Brazil's economy and for the earnings potential of StoneCo, because most of its revenue is derived within Brazil, so the change in the real versus the US dollar doesn't make a ton of difference. As far as their day-to-day transactions are concerned, what we need to focus on is that you are buying a stock in US dollars that is transacting in a currency that is losing value in US dollars. The other second layer to that, and I'm not positive what StoneCo's loans are like, but they could have loans in US dollars. And so with the weakening of the Brazilian real, that makes their loans more and more expensive to pay for because, every day the money that they're using to convert to pay those loans is worth less and less. So there are a couple of ways that the value of this company can be heavily affected by a weakening real. And finally, we're talking about an emerging economy. I do believe Brazil is a strong economy that has, tons and tons of growth ahead of it. But in general, these types of economies are unpredictable. They don't grow in a straight and steady line, much like the United States does at 3% per year every year. No, they could grow at 20% for the next 5 years, and then their economy could crash 30% for 2 years, and then continue with that growth. So it's something that needs to be monitored as well. Just the general Brazilian state of its economy. And currently, there are a lot of worries about the state of the economy, which is why StoneCo, as well as many other Brazilian stocks, are priced so cheaply currently. So if you're buying this company, just know that you are betting on the Brazilian economy as a whole, so you should be bullish on that as well. So with that, guys, thank you so much for watching my analysis of StoneCo, ticker symbol STNE. If you made it this far, you are a champ, and if you have not already, please like the video. Leave a comment down below if you have any sort of positive or negative feedback about the company, about the video, anything really. I would love to talk to you and learn more. I'm always looking to get better as well. So with all that said, I hope you guys have an amazing day, and I will see you in the next video. Bye.